Okay, let us start with economic policy. There are not many questions here in this workbook. However, please note that in the actual test, some of the exercises might be more difficult. They might carry higher number of marks. You might get 2 marks, for example, for answering them. They might be more difficult. Don't expect them to be just simple, basic questions asking you for definitions, right? They might be more difficult, complicated questions. Majority of questions will be based on aggregate demand, aggregate supply model. Sometimes I will ask you what will happen due to certain factors or events or due to certain types of economic policy, how it will affect the economy, output level, price level, inflation, unemployment, and so on. And you might need to sketch aggregate demand, aggregate supply diagram in order to do this. So you might need to understand what curve will shift due to different types of policy. So you will need to know that, for example, monetary and fiscal policy affect the location of aggregate demand curve. Expansionary policy would shift aggregate demand curve to the right, while contractionary policy will shift it to the left, right? Supply side policies will affect the location of aggregate supply curve, and of course, interaction between demand and supply will determine the equilibrium. So, for example, aggregate demand curve can shift due to expansionary policy, fiscal or monetary expansion. It might shift to the right. It might shift to the left due to contractionary policy, fiscal or monetary contractionary policy, right? Aggregate supply curve will shift to the right or to the left due to supply side policies. And of course, interaction between these two curves and combination of different policies will determine equilibrium in the economy, and the equilibrium will establish the national output level and therefore it will also determine employment and unemployment level. They're all related. The more we produce, the lower unemployment will be. And apart from this, within our model, we also have price level, which can go up or down due to shifts in both aggregate demand and aggregate supply curve. When price level goes up, inflation accelerates. When price level drops, inflation reduces. It becomes slower. We experience disinflation. So different macroeconomic variables can be analyzed using this model. Make sure that you understand what are the tools of fiscal and monetary policy, what can be used, which specific tool, which shift which curve, and in which direction. So this is the model where the majority of difficult questions will be based on. So let's have a look at possible answers. Fiscal policy, just a basic definition. Fiscal policy focuses on spending and taxing by the government. Fiscal policy is controlled by the government, and fiscal policy determines the amount of government expenditure and taxes in the economy. Correct answer is B. Next, automatic stabilizers. Automatic stabilizers can be used in order to smooth out the depths of economic fluctuations. So let me just sketch a quick graph for you to illustrate this idea. GDP can vary like this along some trend line. So this might be our long run trend, reflecting the long run rate of economic growth, but the actual GDP can vary. Actual output, actual production level in the economy. Sometimes we can produce slightly above the trend, we can experience very high rate of economic growth, so our economy will be booming somewhere here. For example, if our normal economic growth rate is, let's say, 3% per year, in some years we might experience, let's say, 8% growth. While in some periods we might experience a recession. Our economy can grow at a lower rate, for example, 1% only, or we can actually suffer from a recession when our output declines by, let's say, 2%, right? And government policy aims to smooth out these fluctuations. In other words, we might try to reduce the height of the boom and the depth of the recession. We might prefer these fluctuations to be smoother, so that we are closer to the long-run trend. We don't experience these wild fluctuations. And automatic stabilizers can be used in order to do this. So the aim of the automatic stabilizers is to stabilize the economy, to smooth out fluctuations, to reduce the height of booms and reduce the depth of recessions. That is why when our economy suffers from a recession, automatic stabilizers will attempt to reduce the depth of recession. And in order to do this, expansionary policy must be used. expansionary policy must be used. It's needed to reduce the depths of recession. We need to expand the economy. We need to support the economy, right? What are the expansionary tools? What are the tools of expansionary fiscal policy? How can we support the economy? How can we shift aggregate demand curve to the right in this top graph? In order to do this, we need to increase government expenditure and or reduce taxes, right? So generally, in our set of options, the correct answer will be C. Government expenditure must increase while taxes need to go down. And this has to happen automatically. One version of implementing automatic stabilization is progressive tax rate. How does it work? Progressive tax rate implies that you pay higher percentage of your income in taxes as you earn more. For example, for the first 10,000 pounds, you don't pay any taxes at all. Your tax rate is 0. Let me just draw it here. Just an example. Progressive taxes is one of the forms of automatic stabilization, automatic stabilizers. What does it mean? If your income is, let's say, 10,000 pounds or less, your tax is 0%. You don't pay any taxes. When your income is 20,000 pounds, you pay, let's say, 20% on your income. When your income is, let's say, 50,000 pounds, you pay 30% of your income. When your income exceeds, let's say, 100,000 pounds, you start paying 50% of your income. In other words, taxes go up, taxes increase as income goes up. The higher the income, the higher the taxes will be. How does it work? This is automatic stabilizing policy, because the higher the income, the higher tax you will have to pay, which reduces your income, which reduces your consumption, which slows down the growth of the economy. And this is exactly what we are experiencing here at the boom. When the economy is booming, we don't want it to boom that much, and that is why we will tax people a lot. We will withdraw substantial amount of their income in taxes, and as a result, their increase in consumption level will not be as high as it could be, which will slow down the growth of our economy. And the other way around, when the economy is in recession, right? So this is what we have here. When our economy is in recession, it implies that output is lower, people earn less income, which will automatically reduce the amount of tax which they have to pay. In other words, the economy is automatically supported. You pay less tax, which means that you have more disposable income left in your pocket. You will be able to spend more, and your consumption level is going to be higher than it could be without this automatic stabilization built in, right? And a government sometimes need to rely on these built-in measures in order to reduce the sluggishness in the economy, because there are lags in economic policy. This is what we'll cover in a minute. Sometimes the government needs to react quicker than it could to smooth out these fluctuations, and automatic stabilizers help to do this. So in recession, there will be expansionary policy built in, which implies that we need to increase government expenditure and reduce taxes, while in expansionary periods, when the economy is booming, when we're at the top of the cycle, we'll need to implement contractionary policy. Contractionary policy needed here. And what is the contractionary policy? Contractionary policy is when we reduce government expenditure and or increase taxes. When the economy is booming, automatically you start paying more taxes, which reduces consumption level, right? But government expenditure is also reduced because, for example, you earn higher income, your unemployment benefits or any other social security payments will automatically become lower. You will lose your entitlement to them. You are earning sufficiently, you won't get paid, you won't be supported by the government, which automatically reduce the expenditure on social support, right? Government expenditure drops. Together, this will reduce aggregate demand and it will reduce the scale of the expansion. So what combination of options do we have here? It will be C as well. Government expenditure needs to drop and taxes will need to increase. This is what automatic stabilizers are. So both of these questions are focusing on automatic stabilizers. Next, budget deficit. Budget deficit tends to decrease when GDP increases, right? When GDP increases, it implies that we are able to gather more in taxes, right? Which will automatically again reduce the size of our budget deficit. Country suffering from recession when GDP declines might need to rely on budget deficit, on expansionary policy to support the economy. And that is why frequently government will use this measure when we suffer from a crisis. For example, during the global financial crisis in 2007, government had to borrow dramatically in order to support the economy. And this is what would happen. What happened last year when COVID hit? Immediately, countries throughout the world immediately ran huge expansionary packages, both fiscal and monetary. They've expanded the size of the deficit. They borrowed money in order to support the economy, in order to provide for loan payments, in order to increase other social support, because people lost their income and sources of income and even ability to work, because the country was in lockdown, and actually majority of countries were in lockdown. So when the country suffers from recession, budget deficit tends to increase, again, due to automatic stabilization. When economy grows, budget deficit can be reduced. We can use this extra income to repay the previous debts. Next, the next group of questions focuses on time lags. So this question, and this question. This group of questions. Let me explain the lags. Generally, lags are delays in our actions. So let me just show you briefly, again, using a sketch. Let's imagine that this is our timeline, and at a particular point in time, a certain event happens. For example, COVID hits our economy. This is an event. Happens, let's say, in spring 2020. In order to respond to this event, we will implement a certain policy. We will take some action, right? Policy or action. For example, what we can do, a country can go into lockdown, and in terms of economic policy, we can reduce interest rates. This is what we can do. We can increase money supply, provide additional liquidity to the economy, increase government expenditure, reduce taxes, provide tax holidays, and so on. This is a set of measures which we've implemented in order to tackle the event, in order to tackle COVID, right? And what will happen? The economy will respond. Economy responds. It reacts to this. For example, we've introduced lockdown, let's say in May 2020. We've introduced various policy measures in May, and economy started to respond to this, started to recover, let's say, by autumn 2020, autumn or winter later. How will it respond? Maybe we will experience slowdown in unemployment. Due to furlough payments, some people will be able to keep their jobs, businesses will keep running, right? And unemployment level will not increase as much as it could, right? Consumption level maintained. People were not starving because they've lost income, and so on, right? Inflation growth is reduced due to some other measures, due to price control or whatever. So generally, there will be some reaction. And what is important is that all these events will take place during different points in time, right? There will be a time lag between the event and when the policy is implemented, right? This is what we call the implementation lag. Implementation lag. It's a times difference between when an event happened and our policy has changed. We've introduced some policy measures. We've implemented some policy. And apart from this, there is another lag, the difference, the time gap between when the policy was enacted and when the economy responded to this. This is a response lag in economic policy. Right? It's a time gap between when we've done something and when the economy responded. And it will always work like this. All types of economic policy will have certain lags, but some policies will have larger lags than others. For example, monetary policy is likely to be changed quicker. Why is that? This is because the Monetary Policy Committee of the Central Bank meets 8 times a year, so every 1.5 months, and that is why the time lag is about 1.5 months, the implementation lag. If something happens, the central bank will be able to adjust its policy at the next meeting. So the time lag is about 1.5 months. They don't need to wait for long to respond, to react to various events which require some intervention. They might be able to reduce interest rates, provide additional liquidity, and so on. While fiscal policy is much slower because the budget for the next year is prepared a year ahead, the previous year. So for example, now we have a budget for 2022. It's ready. We cannot change it. It's done already. So what we can change now, we can change our fiscal stance for the year 2023. Right? So if we want to implement certain fiscal changes, they will only start working in 2023 because budgets, countries' budgets are prepared well ahead of time. So that is why, have a look, the implementation lag, the gap between event and policy actions are much shorter for monetary policy. Monetary is not more effective, it's quicker. It's not necessarily more effective. Whether it's more effective or not depends on the particular situation. It's shorter than fiscal. This is what we need. So the correct answer will be C, shorter than fiscal. The response lag. The response lag of stabilization policy represents the gap between the action and when the economy will start working. So generally it's answer C. The time it takes the economy to adjust to new conditions. Time it takes the economy to adjust to new conditions after the policy have been implemented. This is the response lag. Question 5, time lags. Time lags which erode the effectiveness of monetary fiscal policy represents delays in the response to what we do. So time lags is an issue with economic policy. They don't work immediately. Time is needed. For example, we reduce interest rate. Why do we do this? We want to encourage borrowing. We want to support consumption and investment levels in the economy so that the aggregate demand will be higher, which will shift aggregate demand curve upwards, which will boost our output. But it all takes time. For example, I'm quite happy to buy a bigger house if interest rate is lower and I can afford a bigger mortgage. But I don't buy houses every week. It might be a few years before I will make a decision to buy a new house. And it takes time for these policy measures to spread throughout the economy. It takes time for you to decide, oh, it's actually economic conditions are favorable. Maybe I should set up my own business. It will be a while. It can take months and sometimes years. This reduces the effectiveness of policy. Imagine that you are, have you ever tried to row a boat? Do you know what it feels like? Have you ever rowed a boat or canoe or something like this? Yes? If you've ever done this, you will know that you cannot steer the boat immediately, right? You try to turn it, but it keeps moving in the same direction. Imagine you are running a Titanic, which is a huge boat. Our economy is like a huge Titanic. How difficult it is to steer it away from the obstacle. Why did it crash? Why did it collapse with the iceberg? Because it took them quite a long time to turn the ship. And by the time they've noticed the iceberg, it was too late, right? It takes a while for you to turn your ship away. The problem is, by the time you turn your ship, it might be that you are there is another obstacle ahead, and you are moving towards a new obstacle, or by the time you've turned to the left, for example, you need to be steering to the right because the economic conditions have changed. You've implemented an expansionary policy. By the time it starts working, maybe you should be implementing contractionary policy instead. Right? There are quite a lot of debates about whether you should attempt to actively manage the economy, and time lags is one of the issues with the effectiveness of economic policy. It's one of the arguments against economic policy activism, because by the time the economy will respond to your measures, it might be too late, too little, or too late, or you might need to do something differently instead. So your actions might be obsolete by them or redundant. Right? So these time lags reduce the effectiveness of policy. And the final question here, expansionary monetary policy. This question actually asks you about how monetary policy is implemented. Central bank does not print money in reality. It doesn't just distribute helicopter money, it doesn't give money away to households, for example. It doesn't work like this. How increase in money supply actually takes place? Through open market operations. So, for example, expansionary monetary policy implies that central bank wants to increase money supply, money stock in circulation, money stock in circulation. And in order to do this, what they do, they buy bonds. They go to the open market and they buy bonds. Why will it be an expansionary policy? Because when they buy bonds, they pay with money. They pay with money. Central bank can increase their own money balances by any amount. They can simply increase the numbers on their balance sheet. They don't even need to print physical money. They simply can increase the value of their account, basically. They can add a few additional zeros. But how can this money be provided to the economy? How can they enter the economy? Through central bank buying bonds. They can buy bonds of other commercial banks, for example, through individuals, through various institutional investors. Whenever someone sells you something, you pay for it with money, right? When central bank buys bonds, it transfers money to, let's say, commercial banks. Commercial banks will have more money at their disposal, which means that they might be able to provide a bigger amount of loans and so on. Money enters the economy through central bank buying bonds. And the other way around, when central bank wants to reduce the amount of liquidity in circulation, it will sell bonds instead. It will sell bonds, commercial banks will purchase it, so central bank will withdraw liquidity from circulation. It removes money from other entities by selling them bonds, usually government bonds or some other papers, commercial papers, some securities. So generally, expansionary policy implies that government securities or bonds are purchased on the open markets. Usually these are government bonds. Right? They buy bonds, pay with money. That is why this is an expansionary policy. So this is a question about technicalities of how monetary policy is conducted. Okay? Any questions based on this? As I said, in the actual test, you are likely to come across a few more difficult questions. Here, I've covered the most important concepts you need to understand: automatic stabilization, lags, effectiveness of policy. But please be prepared to use this particular model, aggregate demand, aggregate supply model. Make sure that you understand how each curve shifts, due to what factors, to the left or to the right. Right? There is a mock test as well on the Moodle, a short test. You can attempt this as well. It combines questions from various other topics. So that's it for today. I wish you best of luck in your test. Right? So it will cover all macroeconomics, every topic starting from national output up to and including economic policy. That's it for today. Thank you very much. Good luck.